Good afternoon, everyone, and thank you for joining today's webinar. We're going to wait just a minute or two to let people join in, and then we are going to get started. But thank you guys for hopping on and spending some time with us. Okay, well, thank you guys for joining. So welcome to 360 Financial's Maximizing Wealth, Efficient, Effective Estate Planning for High Net Worth Families. We're delighted to have you with us today. In this session, we'll dive into the complexities of estate planning and how it can make a real difference in managing your assets. I am Will Grant, a certified financial planner and certified private wealth advisor here at 360 Financial. So today's agenda, we'll explore the importance of estate planning and a few things that you should consider. So here's our guest panel. We have coverage and experts on all four pillars of wealth, covering from our professional team in estate planning, tax strategies, assets, investments, retirement, and risk management. So first we have Andy Lehner. He's an attorney at law specializing in wills, trust, guardianship, conservatorship, and probate. We also have Joe Rapacki, CPA, the founder of Rapacki & Company firm. Joe has a strong interest in taxation issues. He brings to the table a deep understanding of the intricacies and challenging nature of the financial scene. We also have Mike Rogers, president and founder of 360 Financial. As a fiduciary, he utilizes his 30-plus years of experience to orchestrate and implement customized strategies specifically tailored to address the issues and concerns of qualified retirement plan trustees, high-level professionals, and thriving business owners. And I am Will Grant, as I mentioned, a wealth advisor here at 360 Financial. So with all these professionals on hand, we'll also have a Q&A at the end to address any questions you may have. Please feel free to add them to the chat or Q&A section as they come up, and we will address them. Also, if you'd like to learn more about 360 Financial and the services we provide our clients, please stick around to the end of the webinar for a few more minutes. Also, we have a series, so this is part 3 of that series. So if you missed this or you want to replay it or see a prior series, just feel free to check out our Smart Wealth blog on our website. With that, I'll turn it over to Mike Rogers, the president of 360 Financial. Take it away, Mike.
All right. Thank you, Will. It's good to have everybody joining us today. And the one thing I also will bring up is, of course, Brian Bonsack from our Elk River office is joining us. He's not part of the panel today, but he is going to contribute and ask some questions and then take any questions that you might have as well. So it's just a group effort between the different locations, and it's a great opportunity for us to give you some education and hopefully helps you along this estate planning route. So we'll jump into a few topics, and just when we're talking about the other webinars that we had one basically was titled, "Do I Need a Will or a Trust?" And so that was series number 1, or I should say episode number 1 of this series. And so that's something that was really helpful. We'll cover that kind of quickly as a framework for and ask Andy to come in with a little bit of information about the difference between wills and trust. But if you need more detailed information going back to that first episode, we can definitely send you that because we do record all of these. Okay. Second episode that we put together was about blended families. And so blended families have their own unique situations and circumstances. So we dedicated a 60-minute program just to that situation. And if that is something that's important to you and is relevant to you, we can send you that webinar if you weren't able to make it to session number 2. So today with session number 3, we're going to specifically talk about kind of estate planning for higher net worth families, some of the complexities that end up driving some of the issues around higher net worth families. Might be the same as what we see in the other webinars that we did. So we'll revamp that. And I always like to try to start out with what quote unquote is a definition of a high net worth family. And we'll use a lot of times are the benchmarks here in Minnesota that we have around estate taxes. And specifically, there's 2 exclusion amounts that you can take advantage of, $3 million or $6 million. And so if you're married, if you do your planning correctly, we'll talk about $6 million kind of estate. And then again, I'll circle back with Andy just to cover kind of some of the basics around trust planning for somebody at the $3 million or the $6 million level. One thing we know for sure, as net worth grow, the complexities tend to grow. And so when we look at the characteristics kind of high net worth families, a lot of times they might have assets that are not liquid. It might be in a business. It might be in some commercial real estate. It might be in some land, farmland specifically, we see here in Minnesota fairly often. So that creates more complexities versus if it's money inside of an IRA account. That might be a little bit easier with the estate planning issue than estate planning questions. And then, we also kind of look at the types of assets that are commonly hold. Again, they could be properties, like I mentioned. It could be an LLC, it could be an S corp, it could be a partnership. So there's a number of different business interests frequently that complicates the matters as well for our business owner clients that are, kind of focused in that area. So today, what I think we'll do is just try to understand kind of the differences between standard estate planning and high net worth estate planning and the importance of some of the tax implications in those areas. And that's why we brought this whole panel of people together. So with that, Andy, before I jump kind of into the next slide, could you just do a little high level overview of what we maybe talked about in program number 1?
Yeah, for sure. So wills and trusts are usually the things you think about when you think about estate planning. They're the same in certain ways. That is, you're leaving instructions for after you're gone. And you're answering the same questions. Who inherits from you? When do they inherit from you? In what amount or proportion? And then who's in charge of making sure that's carried out? So they're the same in that regard, but they're different in how they're set up and also how they're ultimately administered when that time comes. The will requires a court process, a probate, and therefore more time and cost, and I'll just say hassle in the administration of the estate, whereas the trust avoids the court's involvement and therefore tends to be more efficient. Trusts also create, certain options for you that we're going to get into a little bit today that may attend to a higher net worth individual as well. But they're the same in certain ways, but they function differently. And I guess it's oversimplification, but one way to think about it is a will is simpler and easier to set up today, but it requires more time and effort and cost later on to administer. A trust is sort of the inverse. It's a little more effort and work to get it established properly, but once set up, it paves the way for a more efficient in both time and expense administration later on. So those are kind of baseline tools that, pretty much everybody's going to want to consider. And it's only where you start to get to the higher net worth where you start exploring some more complex tools like what we're going to talk about today. So hopefully that's enough of an overview for now.
Yep, that's great. That helps just kind of lay the foundation. Again, we can make episode number 1 available for anybody who wants to refresh their memory on some of those nuances. The other thing just with the will and kind of the basic planning that's real important too is as we talk to clients a lot about healthcare directives, that's typically part of that basic plan that everybody should have. Power of attorney would be another one, right, Andy? That is important.
Great. Thank you.
So we just want to get the groundwork set for that, and then now we can build on top of it. So
Yep.
Okay. So how about when we look at, and I'm going to turn this slide over to Will and to Joe a little, when we look at the stepping stone kind of understanding tax liabilities and asset transfers and really what we should be considering when we're moving assets, and whether this is for a high net worth family or or let's call it a moderate net worth family, maybe somebody with, $3 million or more, $6 million or more, I guess would be, at least in Minnesota, the high net worth family. But sometimes, people with $20 million don't think of themselves as high net worth because the federal exclusions, don't apply or do apply to them, and they don't have to worry about federal taxes. So it's really, when we look at these assets, the one thing it's everybody is unique and everybody has their own special situation. So it's really planning for your family. That's the most important part, no matter what tier of, are you high net worth, medium high net worth, that sort of thing, would be what we're trying to drive at here today. But today, with the more complexity to it, Will and Joe, when we look at methods to minimize tax impact, what sort of strategies would you think would be appropriate for our audience today?
Yeah, thanks, Mike. Yeah, one thing we see frequently is people giving gifts to relatives or other people. For 2024, the maximum gift you can give one person is $18,000, which goes up to $19,000 in 2025. What that means is like a husband and wife can give their son a total of $36,000. So it's they could actually give more than the 18 if you have both spouses give somebody the amount. The lifetime gift exemption is the same as the estate limit of 13 million. And as far as reporting requirements, gift tax returns are only required if you exceed that $18,000 or $19,000 of gifting to one person. And there's no tax. You usually don't see any tax being paid with a gift tax return. It just eats into your estate exemption. And as far as trusts, okay, most of the trusts that I see are revocable trusts. Those Andy will talk more about that, but revocable trusts are a way to avoid the probate issue, and they become irrevocable when someone passes away. Irrevocable trusts, we see clients with those, but you tend to stay away from some of these irrevocable trusts because the tax rates are higher. Something to keep in mind. You're not going to save taxes frequently with irrevocable trusts. Let's see here. Retirement accounts, tax deferred accounts. Well, obviously there's IRAs, 529 plans are a way to defer tax. One thing to keep in mind with these IRAs or 401ks to make sure your beneficiary is assigned. Otherwise, it becomes a major problem if there's no beneficiary attached to an IRA, or if there's a old beneficiary that's no longer relevant attached to an IRA.
Mhm.
And yeah, what do you think, Bill?
Yeah, for level 2 here, I think of 2 and 3 as 2 is more immediate risks, and 3 are longer term risks that we work with clients around. So this first piece, asset protection, risk management. So we like to think about this, what could go wrong in the short term? So these are things like lawsuits, creditors coming after your assets, market volatility, fluctuations, and financial uncertainties are another piece that when we do our planning, we're running different scenarios of market upward movements, downward movements, but there are things that you can do. There are strategies that can help. So for business owners, thinking of limited liability entities, separating the business from your personal assets is a very important thing to think through. There's a lot of benefits to doing that for protection for you and your family. The other piece is insurance. So when we think of risk management, you think of your home insurance, you think of your auto insurance, but we think more broadly like liability insurance, life insurance, if it makes sense, and umbrella insurance. So we want to make sure that you're evaluating your coverage needs. If something were to happen to you, that your family is taken care of and that you have things in place. You hope that you don't use the policies, but they're good coverage to have. The other piece is what we're talking about today, comprehensive estate planning. So the roles of wills and trusts to provide clear instructions of how you want your assets to pass. And the other piece is just creating a robust defensive strategy. So all of these things together can help with that asset protection. And it's important to seek out legal and financial advice from a team that knows your specific situation, because there's a lot of different strategies out there. So it's helpful to have the professional team to help narrow down what makes more sense for your specific situation. And that number 3 there is the wealth preservation and legacy planning. I like to think of these as the risk over time. So risk to wealth erosion over time. We have inflation that constantly increases, but we also have, what if you have a health event later in life that draws down a significant amount of your net worth? Those are things that we want to make sure that the plan is built around. So creating those wills and trusts, and as Mike and Andy talked about, those healthcare directives are a great place to start. but also thinking long-term on what type of charitable giving strategies, if that's important to you, in your family, being prepared and active with that. But also, most importantly, is with your children, bringing them into the conversation on how to do that so that they are prepared to inherit, and that they feel confident and they know where things are, is a really important thing that we'll talk about later in the program as well.
Mhm. That's a great overview. Brian, I might bring you into the conversation a little bit, going kind of off script, if you will. But when we talk about insurance, and stepping stone number 2, it really kind of, works its way into a number of different areas, and into number 3, when you're looking at, the financial legacy and maintaining the wealth. And, since you are the resident expert for 360 Financial on life insurance and those benefits, is there any light you'd want to shine on those strategies potentially?
Absolutely, yeah. So life insurance can be used to, when you're younger and still working and still earning, obviously replacing paychecks and giving your family, cash when they need it, need it the most, if somebody's going to pass away prematurely. And as they get older, then we start thinking about other risks that may be coming in later in life, and that would be long-term care or nursing home expenses. So again, I think Will mentioned about depleting assets if somebody would have a health crisis and would put them into a nursing home that's not going to get covered by Medicare, not covered by your health insurance. That's going to come right out of your investment accounts. And the other option with life insurance, to pass that money to the next generation tax favored. Death benefit is a tax-free transfer to your beneficiaries or named beneficiaries in your life insurance. So sometimes people use life insurance to efficiently transfer assets to the next generation through a life insurance policy. So I sometimes look at life insurance as a Swiss Army knife. It's got a lot of tools that we know in a Swiss Army knife, and tools that we use at different parts of our life, younger, older, and at the end of our life.
Mm-hmm. Yeah, I mean, as an example, recently we had a client in, and he and his wife were at, and we're going through their life wealth plan. That's what we call our financial planning program, life wealth plan. And we projected out some fairly substantial estate taxes that were going to be due, because they had a sizable net worth. And then they had already had purchased, I guess for a better word, a life insurance contract. And it was a second to die life insurance contract that would go to the kids, and it basically covered, not directly, but it covered the cost of the taxes to the estate, and made the estate whole by buying the second to die policy. So you talk about a way to protect your financial legacy and maintain your wealth. That might be an option for some of our viewers today to be looking at.
Especially if you need liquidity. I think, Andy and Will mentioned, yes, you may have a large net worth, but it's very liquid maybe at the time of death. And the state estate taxes, the federal estate taxes, are due 9 months after death. So if you are looking around and say, how am I going to pay these estate taxes out of this, estate that I'm in charge of now? And I'm not wanting to sell a building. Maybe it's not a good time to sell a building. I don't want to go into, retirement accounts. There's a bunch of taxes due. The IRS gives us a little bit due. But life insurance becomes very liquid, within 30 to 60 days of passing, and it doesn't come with a tax bill with it. So yes, Mike, that's a great strategy for people to have this liquidity event to take care of that estate bill that's due 9 months after death.
Mm-hmm. Yep. Yeah. Thanks for that. Anything from Andy or Joe maybe that we have not covered on these stepping stones of kind of different levels of risk and financial considerations?
I got plenty I could say, but you guys covered it pretty well. Fact specific, but these are, I think, a pretty good overview of the consideration.
Okay. Yeah. Good. So lots there to cover, and we're not going to be able to go into a lot of detail on each one of these, scenarios, but we can go with an high level overview. And one thing that always kind of brings the conversation to a real good educational platform and point is when we talk and look at kind of some case studies. So I know, Will, you put this case study together. Maybe you can explain the taxes and the scenario here, and what might be a benefit for these people to consider.
Yeah, so this is it's John and Jane Doe, so not any real client information, but our life wealth plan process, as Mike mentioned, is customized to our family. So what I did here is, it's a common thing that families want to support their children during their lifetime as opposed to possibly waiting until death to see the benefit. So like a common example is a child's graduate college, they're starting their entry level position. They're at a lower income level, but they want to buy their own house. You want to be able to support them. So this are where things like gifting could be part of a consideration. And so Joe touched on the specifics of that, but what we do here is build in the plan to show what it would look like if you were to utilize that 36,000 that increases over time with your situation. And so you'll see there at the it's that teal color, but the state estate and inheritance tax on the left side is that 756,000 threshold. That's the taxation, the estimated amount. Now, if you compare that to the right, where the scenario of the gifting exclusion, you'll see that decreased 142,000 to that 614 level. So just helpful to see that there's tax benefits that could go back to your family from being able to do the gifting exclusion. You're able to see the benefit during your lifetime. And it's important to discuss with your wealth manager or seek us out to discuss strategies. There's cash donations that you can make. There's benefits to if you have younger children using UTMA accounts. Now there are different tactics behind that and knowing what makes the most sense, but these are things that we help clients with and wanted to walk through an example of how you could see your specific situation utilizing one of these strategies.
Yeah. So what you're able to show here, Will, is kind of like if you would give some money out of your estate, then you pull the estate value down. You're gifting it to the kids. They're able to, generally that's the case to the kids. They're able to use it. Could be the grandkids. They're able to use it. You can witness that use, get some joy out of it while they're making their way through life and trying to, grow their net worth and everything. But also the benefit is potentially this reduction of your estate taxes because you've reduced your estate while you're alive instead of passing it all on when you've passed away.
That is exactly correct. And that's referenced by the 8.8 on the left side versus a 7.7 on the right side. It's that gifting throughout your lifetime. Exactly correct.
Yep. Which in turn reduces your estate tax, so it's and again, it's one of those scenarios where you want to have, your advisor, whether it's your wealth manager or your CPA, and we're really good at doing this, run some projections that you're not, as the parents, you're not like jeopardizing your own well-being by gifting too much money away while you're alive, so it's, again, we got to just do some really good planning, but this is a nice gifting tool to use to help clients and to help children and grandchildren if that's something that's important to you. This slide really kind of just gets into a little bit of when we're working with business owners specifically. There's always certain areas that we want to focus in on as far as the business owner succession and ownership structures. We're not going to spend a lot of time on this today. We do a lot of consulting for business owners around this area, but I know it's not everybody on the program. So if you're a business owner, circle back with us after the meeting to talk about kind of specifics around your scenario and your situation, if we haven't had that conversation already, because I do know that people joining us today, a good handful, majority of them are current clients of 360 Financial, but there's also a number of people that are joining us that are not utilizing our services yet. So just circle back to us. But with business succession, there's really a few different areas that we want to focus on. First of all is how do we ensure that the family business has a continuation plan? And what does that look like? And how do you develop a comprehensive plan that focus around explaining to your family what are the needs of the plan of the business, and which key family members do you kind of bring in as successors to the business to support it and to grow it and to nurture it, if that's something that is what you're trying to achieve from a family perspective. If you have a business that isn't going to the next generation, that could just create a liquidity event that might be part of this ownership transfer strategy. And then it's going to be really important to have professionals like Joe and Andy really looking at the tax implications of a sale of a business, specifically Joe, and how to kind of minimize that to the family and what strategies you might need to take a look at. And then, at the bottom here is really this kind of leadership. If you maintain the business, who's actually going to run the business, and what's the framework of that going to look like, especially in a family environment? If you've got a family business, when you're preparing the future leaders to take it over, that's one thing. But how about if you have some kids that aren't involved in the family business and there's conflicts that potentially come up because of that? And is there a mentality that we have to treat everybody equally, or do we have to treat everybody equitably based on what's going on with the business? And how do we develop some open communications to strengthen those relationships while, let's say, mom and dad are still able to guide the family along this path? So business succession and ownership structures are very, very important, but it goes way beyond, do I need an LLC or an S Corp, or do I set up a family partnership? And we'll talk about those in a minute. It goes into this whole conversation of who's going to run it, how are they going to run it, what happens to the people that aren't running it or aren't involved with it. And I always tell people, anticipate at least a 3-year process to kind of build this into place, and more is better when we're looking at going down this path. So anything you guys would like to add on to this concept of business succession and structures?
Just highlighting that it's pretty fact specific, and the nature of the business and who you want to take it over is really going to dictate your conversation. And so you start with that and then you get to your professionals and figure out what things apply. But yeah, there are weeds to get into with this that are beyond what we've got for today. But this is a good starting point in spotting the issue.
Yeah.
I think it's a challenge sometimes if there's more than one child and the parents decide that one child is more suitable for the business than the other, so they have to figure out how to structure their estate.
Mm-hmm.
Yeah, to be fair. Yeah.
Yeah, it's a big conversation piece. If everybody's all involved in the business, that's maybe one thing. But again, everybody brings skill sets. Everybody's, the people are good at what they're sometimes just naturally good at, or at least what they've learned and studied and become good at. So different roles and responsibilities are something that would also be very, very important on any sort of business transfer inside the family.
And sometimes they're not interested. Some kids aren't interested.
Right. Yep. Well, so, and in that case, another conversation develops. How do you take care of that child who's not interested in the business versus the one or two other ones that are very interested in the business? So lots of great discussions to be had. We've worked with families on having these discussions. We encourage those discussions, and we can give you some frameworks if that's your situation. So with that, I'm going to move on to the next slide, because this gets into some of the mechanics, whether you're a business owner or just high net worth individual or a family, that's over this $3 or $6 million threshold. And the reason we use that number, by the way, is because in Minnesota, we have an estate tax, like I mentioned earlier, and that estate tax can kick in. The rate as high as 14%, and it could be at $3 million or it could be at $6 million, so with that in mind, Andy, I think I'll bring you in, but of course, everybody else can give input as well. But when we look at different types of trust, could you kind of cover some of this and the nuances of the differences between the different things that we have up here on the screen?
Yeah, for sure. To me, this slide looks like tools in a toolbox. And depending on your situation, these may or may not apply in different ways. But these are different tools, and depending on your goals and situation, they may, apply to you or not. So Joe mentioned earlier, revocable trusts versus irrevocable trusts. Revocable trusts are really the most common that we see for kind of standard estate planning. When someone uses a revocable trust, they're in total control of that trust and everything that it owns. And similarly, the individual who created the trust and the trust itself are the same taxable entity during the lifetime of the individual. So there's not really any income tax considerations. if you get to a point where you're above this $3 or $6 million threshold and we're starting to look at estate tax exposure, someone may consider employing an irrevocable trust in addition to their, standard revocable trust. That's different in a few different ways. Obviously, once it's created, it cannot be changed or revoked because we call it an irrevocable trust. But it's also a separate taxable entity from the individual. So now there's a new set of income tax considerations to talk through. But part of the reason someone would consider an irrevocable trust in a higher net worth situation is because this is a place you can land some of your assets to remove them from your taxable estate. So if you're an individual with $4 million and you put $1 million of your stuff into an irrevocable trust, you're left with $3 million that can be covered by your exemption. And this $1 million that you set aside in this trust is no longer part of your taxable estate. Now, even with that, there's some nuance that I can't go into too much today, but just big picture, that's kind of the concept of how those are going to work for you. So it's this interplay between, gift and income tax versus estate tax benefit, and it's a tool in the toolbox. I guess Brian, our insurance expert, sees irrevocable trusts all the time, I'm sure, with life insurance, right?
Yep.
An ILIT, an irrevocable life insurance trust. Life insurance is a really great thing to place into an irrevocable trust because although the trust can't be, manipulated or changed or amended, insurance policies don't really do a lot during your lifetime. They're a contract for after you're gone, primarily when the death benefit comes into the estate. So if you've got this irrevocable trust, who's the owner of the contract insuring your life is still the event where this becomes liquid, but it's the trust outside of your taxable estate that's going to hold those proceeds, and therefore it doesn't augment or increase your estate tax exposure. So these are just a few quick examples of irrevocable trusts as useful tools for asset protection. I've already mentioned the revocable trusts a little bit. Those don't give you asset protection, but they're highly flexible and changeable and adaptable. And they're the most common tool that we typically would see with kind of baseline estate planning. Now, if you've done, your revocable trust, say in a married couple, to make sure you have both spouses' estate tax exemptions in Minnesota and you're sheltering the first $6 million, and maybe you've employed, your irrevocable trust to remove certain assets, but you've still got additional assets beyond that and you've got tax exposure, we might look at some of these specialized trusts that could give some additional, tax benefits, either an income tax benefit or perhaps an estate tax benefit or some combination of both. And there's a few options listed there, but those are a few examples of many. But if you exhaust this, level 1 and level 2, you can get to level 3 and explore some of the options there too. Some of these, like the charitable trusts, have charitable components. And yeah, I feel like it's probably not so helpful to get into the details of how those work today, but I just want you to know that they're there and they're available and they're worth looking at if your situation is such that you still have tax exposure after employing some of these more standard and baseline tools. And I guess that last point on this slide from my perspective is sort of almost the starting point to say, what is the big picture for you? What are your top priorities? What are the things you're worried about? And depending on those nuances, these other tools may apply to meet your goals, right? So depending on the person and their goals, they may apply differently. But you have to understand that and you have to ask those questions to coordinate these things well.
Mm-hmm. Yeah, would agree with that 100%. The nuances are what drives a lot of the planning, because that's where your wishes are, and what you would hope would be the case as far as where do these assets go to upon your death, and who gets to use them, how do they get to use them, are the things that you get to define and outline and visualize throughout the trust process, whether you use a charitable trust to get there or a donor advised fund to get there. That's the thing that we can help you with from a wealth management perspective. But at the end of the day, you're not really that interested in philanthropic giving, then you're not going to do either one of them. So any input from the panel on different either nuances that you've seen as far as working with clients or the different types of trusts and how you've seen them utilized.
Right, Andy, I get a question a fair amount of people that have revocable trusts, like how often should they have it reviewed?
Yeah. Well, as often as they want to change it or if their situation changes. Yeah, they don't expire, right, by the mere passage of time. So I would say, every couple of years, just reading it through is probably a good practice. Or more frequently, what I see is when something happens, when there's a life event, someone got married, there was a divorce, someone passed away, the business really took off, or whatever it might be. Usually it's the life event that kind of triggers the look at this stuff. And a lot of the times it's an afterthought, like, oh gosh, we've been so busy doing this thing that's happened. We should probably look at the old plan and make sure it still fits.
Yep.
So not an automatic number of years, I would say, but more like circumstantial, but
Yeah,
periodically, one way or another. Yeah.
Yeah. Yeah, at least reviewing it. We do vision review meetings with our clients at least once or twice a year. And we always review the beneficiary designations on their retirement accounts. It's standard practice, been doing it for years and years, and I think it should be standard practice. Let's review your estate plan documents. Like you said, maybe it's every other year and it might be, well, there's nothing to do because nothing drastically has changed. But if you came into a windfall, that was unexpected of some sort, whether you inherited money from somebody else or a business that became liquid because of a sale of it, now all of a sudden, maybe things are a lot different than they were when you drafted that document even a year ago, or 6 months ago, if it was really out of left field, so to speak.
What's also important is when you create your trust documents, which is already a big check mark and kudos to you, is looking at your net worth and getting things into the trust. So that's where we work really heavily with when you have your trust documents finalized and ready to go. It does no good unless you place assets into trust. So those are things that we help our clients with all the time. And it is from time to time you see that they're not in a trust and they should be in a trust. And those are things that we help clients with, which is very, very important from the long-term estate planning perspective.
Yeah, that's a great point. Well, if I had a nickel for every time I saw somebody that had a trust and their assets weren't in the trust when they came in to visit us, kind of as a potential client, I would be doing just fine, because it seems frequently that the Andes of the world draft up these beautiful trust documents, they get them all set up, and then they never get funded by moving the assets into the name of the trust. And it's not that hard a process. You just have to spend a little time doing it, and we can do it for our clients. That's a great point. Thanks, Will.
Yeah.
I tell that to my clients all the time. We can lead them down the path to creating this trust and give them all the instructions to fund it. But if they don't actually do it, it's going to frustrate a lot of their potential benefit from that trust. But having an established relationship with an advisor like 360 Financial, it goes a long way into taking this thoughtful document that you put together and spent some time and energy and resources setting up and making it work properly. So yeah, having those coordinated professionals has real value, and that's a really poignant example of that.
Yeah. So, okay, so let's do this. Let's jump into another case study. Will, again, I'll let you lead this and then this discussion, and then set up the premise of what we're looking at and maybe what the outcome was by just taking care of things properly.
Yeah, and this kind of goes off of what I was saying too, where let's just say the newer client came in the door, we're looking at their overall plan, and we identify a joint account. So it's not held within a trust, and we know from our prior conversation it's important that their assets are aligned to their plan. But they're in a scenario where it may make sense to utilize an irrevocable trust, where you place it from where you have the ability to manage it to now the trust owns it. And so this scenario here on the left is kind of the baseline. So you'll see that at the total tax and expenses, that 1.96 million level. And then when we go to the right side is the use of the transition that joint account to an irrevocable trust. So what you'll notice is different at that top right corner is a gray bar that shows an irrevocable trust, and it's held out of your estate. It's a very important thing to identify because when you go towards the bottom of that page, there's a gray bar that shows taxes and expenses after Jane's estate, that's 6.2 level. And you'll notice that the tax and expense there is 1.3 million, as opposed to, we talked about getting things out of your estate helps lower that state estate tax or total estate tax threshold. Now, from a total heirs perspective, because you're able to keep more of that taxes for your family, you'll notice that on the left side, the two heirs in trust and charities is at 6.85 million. And now towards the right, you'll see that the total heirs is 6.926 million. So again, just utilizing different tools in the toolbox to help you accomplish your ending goals. And so an irrevocable trust is just a scenario that I put together here to show your specific situation and what the analysis could show there.
Mm-hmm. Yeah, great job. And it gives again, everybody's different. You might not need or want an irrevocable trust. And that's why it's important to talk to your estate planning attorney, with your wealth manager, with your tax person, just to make sure that that's really something that would either benefit you and you understand the pros and the cons and of different strategies, So good overview on utilizing different types of trusts. Thanks, Will. When we look at, again, from a family perspective, a number of things, and this is almost the same conversation we had back with the blended family webinar that we did a couple of weeks ago. Really have to look at, and Andy, I'd love some feedback here from what you've witnessed and anybody from the group, but we really have to look at kind of the diverse needs of all the family members when we're doing any of this estate planning. And whether it's just up here, number one on the right-hand side, the financial circumstances and the equitable estate planning, like I had mentioned earlier, do we need strategies in place to, provide for minors? Maybe it's grandchildren. Do we have the next generation of people receiving this wealth? Are they financially savvy, or is there still a learning process and education that needs to be delivered so they're good stewards of these funds and this responsibility? And how do we use, as we kind of talk about those family circumstances, how do we use kind of advanced estate vehicles to maybe help drive those outcomes, so that we lead over to this third spot? That's really the responsibilities and the support that the family receives around open dialogues, clear instructions, clear guidelines, clear expectations, which leads hopefully right up to this top left side of the chart where, we've got a family legacy that's not bruised, that's in a harmonious state, where the family members understand, because we've gone through this whole wheel of different education and circumstances and planning to kind of create this legacy for when somebody does leave these assets behind. So this is a really powerful slide that we could spend 3 hours going through, but I would love to get some feedback from the panel on the slide, and specifically anything that you can share from your experience perspective around these bullet points.
I mean, this is exactly the crux of the nature of my work with folks, helping to set up an estate plan that's going to work well for their situation. And it starts with this conversation of, what are your goals? And it might be a story about a family member they want to provide for who has special needs, or has a demonstrated concern, whether it's an addiction or an inability to manage money properly. How do we set up structures so that they're included, but they're included in a way that's going to be harmonious and productive, and hopefully promote growth and support them, right? Not just hand them a blank check that's going to lead to their demise or something wild like that. So having that initial conversation and understanding the concerns that are particular to each family is critical. And this slide, I think, illustrates that really, really well. And you ask if anybody has any insights or stories, Mike. I've got a lot of stories. I don't know if we have time for them today, but just a quick example. I'll tell you, in a 3 generation, a grandparent who had done very well, but part of the reason he had done well is because he primarily funded his son's small business, which has of course now taken off. And it's led to great wealth both for dad and his son, which is great news for their family. But now from that perspective, they're asking questions. Well, what now? And dad doesn't want to necessarily continue to enrich his already well-off son. And so he's looking to the next generation about skipping to the grandkids. But of course, they're young. We don't know how they're going to turn out. Are they going to be financially responsible or not? And so he's creating irrevocable gifting trusts for the purpose of receiving gifts from grandpa to grandchildren during the grandchildren's lifetime, but having a trust catch it instead of the individual grandchild, so that the trust can have some guardrails and some protections until they reach a later age. That's just one really quick example of like trying to look through this whole circle of fitting it together, not only, from asset to asset or from one generation to the next, but maybe beyond that. So it's really particular with the family, and it's important to have a conversation with your financial advisors, attorneys about your goals so that we can apply tools to accomplish these goals. I think this slide's great at illustrating that.
Yeah, I would agree. And what this slide really does is it brings into top of mind a lot of the things that you want to have conversations around. You might not know what a spendthrift provision is, but you do kind of know. And again, the bigger the net worth, a lot of times the more complex this becomes, right? Because the next generation are going to inherit potentially a lot of money. And so you want to really make sure that they are in a situation where they're able to handle it, And so maybe a spendthrift provision where they can only spend so much money a year, or at a certain age, or certain ages into the future, or for certain purposes, would be something that would help you accomplish that.
I think the biggest takeaway for me with this is this process allows your wealth to be an opportunity for unity and not conflict. So when Joe is talking about, there's someone who wants to be in the business as opposed to a sibling who doesn't want to be in the business, how do you make it fair so that you don't have conflict within your immediate family? That is the biggest thing that the peace of mind that your family can obtain by going through a process like this. So,
and I agree. I mean, I've seen that a lot. I agree all with you, Will. I mean, I've been doing this for over 30 years. Unfortunately, bullet point number 4 doesn't get realized often enough, that I've seen in families that come to us for some help, and it seems like the bigger the assets, in other words, the bigger the net worth, the bigger the estate, the more kids, the more potential for conflicts, especially when they have not laid the groundwork for expectations by, the parents or the grandparents who are kind of controlling the trust. So it's just
Yeah. And one idea to eliminate some conflicts is hiring a corporate trustee. This is a third party person that's outside the family, and let them come in and help be that trustee, help them, kind of direct and control, and maybe take away some of those difficult conversations and those difficult decisions away from working with a sibling or, somebody else in the family. So that's been a topic as well lately.
Yeah. That's a good point. And there's all kinds of different corporate trustees you could hire. It could be a bank trustee. We work with some independent that brings a little bit of the corporate trustee is just managing the trust. There's not a personal interest in it. They're just trying to follow the bylaws of what was established by mom and dad, if you will.
Yep.
Good point. So there's a number of different things that you might look at, from a planning perspective, and because we're maybe getting into the weeds a little bit and we don't have more than an hour for this conversation, I think we'll just go at a very high level. Andy, maybe we could talk about some of the different types of partnerships or planning techniques that might come up in a conversation, with these higher net worth families. How's that a nice way of
just
laying that out?
Something like a family limited partnership or even an LLC for a family is a way to transfer wealth kind of smoothly over time in bits and pieces rather than all of it at once. And there's some things to explore around potentially a business type structure like this in an estate plan, and that's an appropriate tool for certain types of families. Pooling assets is an efficiency tool where maybe you've got a group of young beneficiaries where they can all have things invested kind of together until one of them reaches a certain age, and then it's divided after then. So it's just efficiencies during a certain season or life cycle of the administration of the trust. We've already talked about some of the advanced planning techniques, including the life insurance trusts. Each of these has a different set of considerations as far as costs, both monetary and control and hassle on the front end versus potential for asset protection, preservation, efficiency of transfer of wealth later. And yeah, like you said, without getting too far into the weeds, I guess the message here from my perspective is there are a diverse number of tools, and they're going to apply to different families in different ways. And starting with that conversation is going to probably be the best way to engage with these. But again, there are tools in the toolbox.
Mm-hmm. And with those tools, I mean, one of them I think that would pop up to people that like, oh, what's this mean? When you're looking at the benefits of pooling assets and you look at discounts for gift and estate tax purposes, could you just give a little flavor of kind of what that means?
Yeah, so I mean, just as an example, if you've got multiple beneficiaries of a trust that's going to provide for, say, a group of grandkids or something like that, you can give individual gifts under this gift tax exclusion for each of those individual beneficiaries and avail yourself of each of those individual gift tax exemptions in any given year, and it can sort of multiply the power of an annual gift, right, to a group of people, but still have the efficiency of having everything in one place and having it managed in one place, at least for a while. So yeah, I mean, there are not only like control and personal preference benefits to this, but also potential tax benefits too.
Mm-hmm. Yep. Yeah, good. So again, number of different tools in the toolbox that we could use. And really what it comes down to is, when we're starting to go through this ebbing and flowing of, when we go through this ebb and flow of, structuring an estate plan, it really does get into a scenario where, getting some updates here that aren't supposed to be on the screen. So I apologize for that. So when we get into the ebbs and flows of changing laws and regulations, this is one thing that comes up frequently for people. Is there anything that we'd like to talk about as far as this kind of four-step area where compliance, monitoring, different strategies, and the benefits of the proper structuring of this compliance and high net worth structure of planning is concerned, specifically maybe around evolving laws and regulations, starting there on the compliance piece,
Yeah, I mean, this goes to what Joe was asking earlier, I would say, about how often do we update these things? How often do we read them? And I guess this is maybe a more particular answer to that question, to say laws do change and situations change for individuals. And those are the things that often drive change. So naturally, you want to make sure your document's going to work under the law that's in existence at the time you create it. But then you also have to be paying attention to those law changes, and professional advisors are excellent resources to doing that work for you, so you don't have to worry about it. Whether that's your, well, anybody represented here can play that role to a certain extent. Those changed laws, of course, might lead to changed strategies and structures. So to me, this is just fleshing out a little bit more Joe's question. It is kind of how I see this.
Mm-hmm. Yeah, because what ends up happening, of course, is tax laws change. I mean, we just had a scenario where we went through an election, in case anybody wasn't aware of that. And there was some concern really about how that election turned out, what might happen to tax law going forward. Now we have the uncertainty of the election behind us. We probably have the uncertainty of the tax law changes behind us. And then we can do some better planning around what we think is going to be happening, at least for the next 4 years around tax laws, and then what Joe mentioned earlier too was the estate tax amount, the gifting amount changes from 18,000 to 19,000. So again, that's part of the monitoring of it, and then making sure that we just have strategies where we're regularly reviewing and update all those changes and working with your team to get that done. And at the end of the day, what you're trying to do is protect your assets and protect your net worth, so that it benefits the family the most. And then the optimization of the tax code is a way to do that. So I think if you look at this, it gives us a nice ebb and flow of how this is a working document, if you will, and working arrangement. It's never a set it and forget it type of arrangement. So, with that in mind, we just bring it to this page here, with kind of wrapping this up. We're right at the top of the hour. I know we have some questions that have come in through our audience. So this might be a good time for us to take some of those questions, but thank you very much, Andy. Thank you, Joe. Thank you, Will. And thank you, Brian, for being part of this presentation. Whenever we can educate people more and they can make better investment decisions, estate planning decisions, tax decisions, then we're living what we're supposed to be doing here at 360 Financial, which is enrich our clients' lives by navigating through these financial issues that they all have. So thank you for spending some time doing this. And with that in mind, I know there's a couple of questions that have popped up. Will, as our monitor, do you have a couple of questions in queue?
So we don't currently have any questions in queue. I encourage them if you have them. Otherwise, if you feel like they're more on a case by case, or you want a personal consultation or discussion, we will make sure that we get in contact with you as well.
Okay. Well, I've got a question, and from the standpoint, frequently we have people come in that ask us, I set up a trust. Should I put my IRA into the trust? Of course, everybody's a little bit different as far as the reason they may or may not want to do that. But can anybody on this panel give a couple of examples of where this has come up and maybe what the outcome was for that discussion? Or even what are the pros and the cons of having your trust as part of the IRA beneficiary designations?
Well, I mean, that's a conversation I have with clients every time we set up a trust. And I guess the basic principle is that things like IRAs and 401ks, of course, are tax deferred. They're qualified accounts, which means no one's paid income tax on those dollars. And so that means whoever withdraws those dollars gets to pay the income tax, whether that's the owner of the account during their lifetime, or whether that's someone who inherits the account after the death of the owner. And so if the trust becomes the inheritor or the beneficiary of a tax deferred account, it means that the trust would get to pay the income tax. And as Joe pointed out earlier, the rates of tax for trusts are not the same of the rates for individuals, right? They're more compressed brackets. And so you ratchet up to a higher rate of tax more quickly, and it's a more severe income tax treatment. So that's one of the considerations with qualified accounts in regards to trusts. To me, the flip side of that then is, who are your beneficiaries? Because if they're minors and they're young people, you have to ask about the detriment of that. You create a new set of problems if you're naming a minor as the beneficiary of those accounts. Although they might have individual tax brackets, you might say, hey, it's better for me to have a more severe income tax treatment for the protections that are available within the trust. So an individual has to balance some of those things as they determine the answer to that question. That's my 2 cents.
Yeah,
Mm-hmm.
I agree.
Anything, Joe, that you'd want to add on the tax side?
Yeah, when we see IRAs or retirement accounts in a trust, it gets kind of complex. So, and the document needs to be clear as to how it's going to be handled, because whenever I've come across it, there seems to be some vagueness on what to do. So, yeah.
Yeah, and I just took us off of this screen share, but I would agree with you. It's really, again, gets back to that conversation. Why would we do that? What's the goal? What are we trying to accomplish? Typically, I found after doing this for a number of years, at the end of the day, we end up with individuals as beneficiaries, not trust accounts as beneficiaries. Not all the time, but frequently. Especially when they're adult children that would be inheriting upon the second death of the mom and dad IRA accounts, because we know, generally speaking, the IRA or an old 401k will go to the surviving spouse first. So a lot of these conversations are going to be upon that second passing.
We did get a question. So it is, should CDs be in trust or should be a beneficiary?
My experience is that CDs typically come with a beneficiary designation as kind of a standard piece of setting up the CD. They can be owned by a trust. So if you had a trust established, I would say it's a good idea to have it in there. But if you've got a beneficiary named, it's going to avoid probate and go straight to the named beneficiary if you're the owner of the CD at the time of your passing. So the short answer is, I don't know, maybe either. Actually, I
Mhm.
learned in law school that the answer to every question is it depends.
Then
So that's true here too.
Yeah, again, depends on what your outcome is, isn't it?
Right.
What you want for your outcome. You bring up a good point though, Andy, is a lot of times, and I've seen this as well over the years, a lot of times people will go through some estate planning. They may or may not fund the trust and that sort of thing, but they forget that the beneficiaries or maybe an old payable on death or transfer on death account that they have at a brokerage firm or at a bank won't ever go through that trust.
Mm.
And so those kind of bypass all the work that you've done when you put that together. So I think that's an important piece of it too.
And
That
maybe
does
that's
occur.
okay, but don't overlook it is the point, right? Make sure you
Exactly.
want it, right? Yeah.
Mhm. Yeah. Well,
Okay.
all right. Well, everybody, thank you very much. We're going to wrap it up. We're at the top of the hour. For some people who want to learn more about 360 Financial and our life wealth process, stick around. We'll cover that in about 6 or 7 minutes. Just an overview in 6 or 7 minutes, just to give you an idea of how we work with clients and what makes us unique. And but for the panel today, thank you again for being here. Hopefully, for our participants, it was a great educational opportunity. And whatever questions that they have that might be on the tax side, Joe will make sure that they contact you. And on the estate planning side, Andy, they contact you. And we bring the experts onto the field so that we can make sure they're taken care of.
And for the audience as well, we will have our next webinar in January for the outlook on the market. So keep an eye out for that communication as our next presentation.
Yep. Great. Thank you. And 2025 could be another interesting year. So we'll see. But stay tuned for that presentation. That'll be next month. Thanks, Will. Okay. So I'm going to get back into the screen share and we'll again just kind of go through for people who are either taking a refresher course or people who are brand new to 360 Financial, kind of what we do and how we do it. As Will mentioned, we will have this webinar available as a replay. If you're interested in receiving it, we'd be happy to get it out to you. And generally, when we look at different disclosures, we didn't talk anything about investments today. It was all estate planning. Obviously, 360 Financial is not a law firm. That's why we bring the experts in, like Andy, to talk about law and law topics. We offer investment advice. We also have Joe as part of our team here that we offer tax advice through his entity. So when we're working with clients on kind of the overall approach to wealth management for our potential clients, we always start with kind of this Venn diagram. And this is really the root cause of the planning process and the foundation of what we do here at 360. Specifically, we are always focused on what matters to you as a client. Okay. And the importance of that is what drives the entire plan. And we use this framework and we use it every single meeting about an acronym that we use called FORM. And FORM really is the driver for our planning goals and for the life wealth plan. And it says what matters to you around your family goals. We don't ever want to lose sight of that because frankly, for most of our clients, that's the number one concern. How do I take care of my family? And if you saw this from the presentation, a lot of the estate planning goes into exactly that for that family aspect. Okay. Then we look at your occupation goals. where are you in your career? What would you like to be doing next? If you're near the tail end of your professional career, does that mean shifting to an occupation that's less stressful, that also might be less income? It could be an organization you want to support. But what are the goals around where do you spend your time at work? And what is your work optional date when you can actually be in a situation where you don't have to be at the office? You can instead, or at the facility or wherever it is, you could be doing something differently. Okay. And then we really want to also take into consideration your recreation goals. What is it that you like to do for fun? Pickleball, traveling, volunteer work could be both occupation and recreation. Doing things with the grandkids, building out scenarios within a plan that focuses on your recreation goals is as important as building out any of the money goals, because with family, occupation, and recreation, what we're looking at is the why to the plan. It's the substance of what makes it important. And when we get to your money goals, that's the gas in the engine. That's what drives those whys and really provides a fulfilling life with lots of options and hopefully lots of energy and enthusiasm. For most of our clients, I would say all of them, frankly, money isn't the end all be all. It's not like let's accumulate as much money as we possibly can. It's focused on what's important to me. I want to make sure that my family is well taken care of. I want to make sure my kids are in a situation where they can pursue the goals that they want for their occupations that bring them joy. And I want to be able to share that through travel and maybe a trip to Disney. So can we earmark $20,000 for a trip to Disney with all the kids and the grandkids in 2026, for our 50th wedding anniversary? Those are the sort of things that really bring, kind of the juice to these plans that make them really come to life. On the flip side of this Venn diagram is the aspect of what we can control. And maybe even more importantly, what we cannot control. We know new Congress coming in, new White House coming in, there's going to be some policies that are going to change. Okay, we can't control those, whether we like them or not. But what we can do is we can control the planning process around those changes. We also, from an investment standpoint, might find that there's certain areas of the economy that might do better with this new administration coming in than the old administration. Maybe there's some investment issues that we want to discuss at our weekly or every other week investment committee meetings here that we have at the office. And so a group of 8 of us get together every other week. We go through our investments. We focus on what we can control and what we can't control, just like we do in the planning process. So if we focus on what we can control, it really kind of drives these 3 P's that I'll have here. The philosophy around how we work with our clients, the planning process, which is broken into 3 phases. Discover phase, what matters to you is what we're really doing in that discover. We design a plan to meet those goals for what matters to you. And then we deploy that plan and monitoring on a continuous basis so that we never lose sight of what is important to you. And so that's why we have our service promise. And at least once a year, we have to go through this plan together. Sometimes it's on Zoom nowadays because our clients have moved around the country. But frequently it's in our either the office over where Joe is in Edina, our Elk River office where Brian is, or our main office here in Wayzata. And then we deploy the plans, and the process is repeatable. We keep copious notes. We know that what's coming up in your life because we've had that conversation, and then we can put it into the plan. And so if we focus on the 3 P's, and we focus on your form goals and what clearly matters to you and what we can control and can't control, that brings us right into this sweet spot, which is this ongoing process of a life wealth plan to help manage your goals, help manage your wealth, and lead you down a path where everything is accounted for. And so typically when we look at these form goals, we're maneuvering through these impactful financial events, and so our mission here is to enrich lives. And that's it. That's our mission. Now we do it by maneuvering our clients through impactful financial events like the ones that are listed here. Estate planning, investment management, family security. Maybe that means putting enough money away for a grandchild to go to college without having to take and be straddled down by student debt for a decade or longer when they come out of school. Retirement planning. Could be a second home. It could be focusing on when is my work optional date. So if I elect to do something differently, I can do it. And how do I tax efficiently take withdrawals from money when it comes that time to pay as little as legally I need to in taxes and to maximize my wealth. And then the business owner planning is an impactful financial event because that creates a large liquidity event. That could also be in a scenario where if you're working for a company and it's being purchased by somebody else, you are preparing for a liquidity event there as well. You might not own the business directly, but you do indirectly through that equity position that you hold. So I like to just kind of give an idea of what this breaks down to. When we look at the 4 pillars of wealth management, there's taxes, there's investments, there's estate planning, and there's risk planning. And so on an ongoing basis, we customize this cadence of how do we address that for each of our clients. Now, what time period of the calendar year do we focus only on tax planning and maybe investment management? And then in another quarter, maybe we'll focus on the estate planning. And we do this on purpose because, one, everything is changing as we talked about earlier. And 2, now it becomes a manageable process instead of an overwhelming process by cramming it all into, a short duration. Now, don't get me wrong, your life wealth plan, if you're new to us, will be built in 5 to 6 weeks, typically is the time period, as long as you're engaged with the process. Okay. And, but on an ongoing basis, these are the topics that we're always going to be taking into consideration and discussing in our quarterly conversations or our vision review meetings that we hold once or twice a year. So, from the standpoint, I'm doing a lot of the talking, but Brian, Will, do you guys have anything here that you would want to add either into the process itself around impactful financial events or around quarterly conversation topics?
I think the biggest benefit of this that 360 clients receive is peace of mind, knowing that they're doing the things that they need to take care of their family, that they're on track to achieve their work optional date. They feel like they have plans for living a fulfilling life. And it's our job to help tactically strategize around how to accomplish those goals. And our families are very busy, the professionals, as well as when you're retired. Clients hire us to manage this so that they have the time to do the things that they want to do with their family and with that recreation piece. So it's a really important role that we hold, and it's something that constantly evolves. And the Life Wealth Plan is a living document and a living process that when your life is considering this maneuver, let's update the plan and walk through the analysis. That's a really powerful thing that our service provides families.
Exactly. I was going to add to that a little bit, Will, just that, we do this heavy lifting up front. So when we do come, at a, crossroad in your life or, a speed bump happens in your life, we know how it's going to impact your plan, and we know we can accomplish or handle those changes that might come down the road. So it gives that peace of mind and flexibility to pivot when life gives us a curveball.
Mm-hmm. Absolutely. And the more work that we can put up on the front side of it and we plan around it, the less likely you get those curveballs even, right? Because you've already planned for them,
Yep.
as I mentioned, we do have an investment strategy here that we utilize with our clients. And the one thing that you want to keep in mind is it is customized to everybody's risk tolerance. We use a really nice assessment tool to try to gauge what your risk tolerance might be. And we build a strategy around that as well. And it's something that I just encourage the participants in this webinar, if it's something you're more interested, if you're interested in hearing more about it, just let us know. We can follow up with you, give you more details about our investment strategy, give you more details about the life wealth process and how it may benefit you or might not. And then we can go from there. So I think because now we're at 15 minutes past the hour, I think I'll wrap it up. Thank the people who stayed longer to learn a little bit more about our service and our process. And thank you, Brian. Thank you, Will, for being part of Team 360 here and educating our clients and our potential new clients.
Yeah. And the other thing just to end with is that for current clients out here, we offer our sounding board. So our services are fully accessible to those you care about. If we can help in any way, shape, or form, that is what we're here for. It's included in the service. So please make sure you're taking advantage of that service because it is part of our offering.
Yep. Thank you for that reminder. Very important. So thank you, everybody. We wish everybody a happy holiday and thank you for joining us today.
Take care.